Good morning, everyone. It's 10:05, so I think we can start the webinar. I think we've given people enough time to join, but I think over the next 5 minutes, maybe we'll have some more people joining in. So I think we can start. So my name is Kate Wambui. I'm an assistant legal manager at TaxWise Africa. I'll be the moderator during today's webinar. So the purpose of today's webinar is to discuss essentially the 3 finance acts that were passed recently within the region, specifically for Kenya, Uganda, and Tanzania, just to see the gains and losses for taxpayers, as well as the areas that we would propose for reform and the trends that we've seen over the past couple of years across the region. So I'll introduce today's panel. So first we have Enoch Barata, who is a senior partner and co-founder of Birungi Barata and Associates. I hope I've not butchered that, in Uganda. Enoch also heads the banking, corporate and commercial law and insolvency department at the firm. He has over 20 years of experience in the tax and legal industry, having advised and represented numerous clients in complex corporate transactions as well as disputes. Welcome, Enoch.
Thank you very much, Keta. It's a pleasure to be here with the rest of the panel, and I look forward to this discussion.
Thank you. Next, we have Jiduma Luhende from Tanzania. He's a managing director at Rook Consultants with over 17 years of experience in tax and accounting. He's provided professional services to clients in different sectors in Tanzania and is a registered tax consultant with the Tanzania Revenue Authority. Jiduma, thank you for joining us today. I hope you can hear me. Sorry, Jiduma, I think your mic is muted.
All right. Sorry. Thank you, Kat, for that lovely introduction. And I welcome everyone to the webinar.
Thanks for that. Last but not least, we have Samuel Joroge, who is a tax partner at TaxWise Africa Consulting. Samuel has over 13 years of experience in the tax and accounting sector. He has a wealth of expertise in engagements around transfer pricing, local and international tax structuring, tax advisory, tax disputes, among other areas. Samuel?
Thank you, Kate. Good morning, everyone. I'm looking forward to the discussions.
Thanks for that. So I think we've set the stage for today's discussions. I invite the panelists, and we hope to have a very fruitful discussion. We'll have a Q&A session at the end of the webinar, probably for the last 20 or 25 minutes. So you could just write down any questions that you have in the chat, and we'll screen the same for the Q&A session. So I think just to start off, maybe we can start with something, a bit of a loaded question. Maybe I'll throw this to Enoch, actually. So for Kenya, we have a very politically charged response to the Finance Bill and the Finance Act. And I think maybe this is because of the lack of public trust and the feeling of overtaxation and misappropriation of the revenue that is raised. I don't know if the climate is different for you in Uganda in terms of the public participation and in terms of the engagement around the Finance Bill.
Thank you, Kate, again, and good morning to my colleague panelists again, and good morning to all the participants joining us today. Well, in comparison, the mood is different here, of course, in Kampala. we are relatively, we're actually quite calm, and the engagement on the finance bills, on the tax acts that have been passed, I think is a lot more positive and is a lot more promising. I think we have essentially sort of the same problem, but perhaps it is being approached differently in different places. And that problem is one of perhaps having a larger youth population that are looking to get employment either formally or through enterprise, and you will find that in our act now that we are assented to on 30th June, and it effectively came into force on 1st July, you will find that there is a running theme, which is to create more production, more value addition, and to encourage small enterprise as a means to address the issues of job creation, youth unemployment, and generally involving a larger mass of the population in the economy. So to that extent, the reception of the bills is positive. Thank you.
Thank you for that, Enoch. I think, Juduma, just on the same point, I see that the Finance Act for Tanzania is actually quite lengthy. I think it's actually double the length of the Kenyan Act. So I'm curious to know, in terms of the proposals that were made at the stage of the finance bill, was there a change in terms of what sailed through to the Finance Act? Was there public participation, and sort of the output is different from what was tabled before Parliament?
Thanks, Kat, for the question, and thanks for every participant. I think most of our changes from the bill and in the Finance Act itself, I think they've been structured strategically, because it's an election year for us. So you see very few changes that are targeting individuals directly. So you see most of the changes, especially the penny ones, are targeting entities. So the individuals could not see like a direct link to them. So there isn't much in terms of the public as individuals, but for businesses, for entities, one of the items that was brought a big outcry was in the bill. There was an introduction of taxation on deemed dividends, which was generally just stated all the retained earnings could be taxed after 6 months from the due date of filing the annual return. It became a big debate, because there was even lack of clarity which retained earnings are they accumulated, are they just for that year of income? Is it at 100% of the retained earnings, or just part of them? So now in the Finance Act, there has been a much better clarity on that. First, it is limited 30% of the profit for that year, and also there is also clarification that in subsequent years, when there's actual distribution of dividends, the dividend that was taxed through the deemed approach will be excluded, so as to avoid double taxing the same amount. And also there's an exclusion for CFC resident entities that are controlled majority by associated corporations from outside, so as to avoid them being taxed on the deemed rule in Tanzania, and then also on the CFC rules, which could apply to countries, and as well it could also discourage foreign entities investing in the associate companies in Tanzania. So at least at the finance bill level, we see there's been a positive direction when you compare to how it was structured in the bill. I think that was one of the major if I compare the bill to the Finance Act.
Thank you, Chiduma, for that. I think the provision for deemed dividends is actually quite similar to the Kenyan income tax law, including the provision for the adjustment once you've, or in the event that you subsequently distribute dividends. So I think that clarification was a good one. I think, Sam, we can move on to you. So maybe you could tell us some of the gains and losses that you've seen in the Finance Act, things that you think are an opportunity for taxpayers to leverage on, and some of the losses that are a bit of a hit on taxpayers.
Thanks, Kate. So we can start with what is the bad, ideally, of what the current Finance Act. So the bill had some very hard-hitting amendments that KRA were trying to impose. The issue of access of taxpayers' documentation, financial records without going through the proper channels. At least that one was deleted. And then in the bill as well, you had trying to broaden the definition of what a royalty is, as KRA tries to get more withholding tax on all the royalty payments that are being paid within the country. Again, that was deleted. So that's, and then also, of course, the issuance of an agency notice where KRA would freeze the bank accounts, even if you have already appealed. Again, that was deleted. So there, the Finance Committee did listen to taxpayers. However, there were still various items that, looking at it, are detrimental even to the tax authority itself in terms of tax collections. The first one is in the shipping industry, where the definition of what is income that is going to be taxed, or who is going to tax that income. So at the moment, there is going to be a lacuna in how that is defined. And let me explain. So when it comes to shipping income, freight is what is taxable in Kenya at a rate of 3%, I believe, depending, of course, on the double taxation agreement. So this is paid mostly by the agents, and this will be paid on behalf of the principal. That's what has been the case. Some few years ago, the tax authority tried to tax demurrage. So demurrage basically is the fee that is payable for utilization of the boxes, the containers that are owned by the liner, the shipping principal. And that case is currently at the High Court, at the Court of Appeal. And we do expect that there's going to be a ruling coming in. So definitely anything that is coming inbound, and it's not for transit, then you'd have freight tax being paid. However, there's a curious amendment that has been put in. So first was to state that any income that is being sourced could be looked at as taxable within Kenya. Then on top of that, they've proceeded within this Finance Act to include an amendment under the withholding tax provision, Section 35, stating that outbound, because basically inbound freight is already taxable, outbound would be taxable in Kenya. Now, the problem with that, and the reason why I said it's detrimental to KRA itself in terms of tax collection, is one, for outbound cargo, there's little demurrage, if any, because for any shipping line, you're looking at getting your boxes or cargo outside. and you're looking for business. So most of the time, you're not going to have any outbound demurrage. Inbound demurrage, yes. But inbound demurrage in terms of definition is already covered under freight. Yeah, because a demurrage definition in international law is freight, and that one is paid as per the respective freight tax provisions. So there's going to be some disputes. We hope that there'll be a bit more clarification. And the biggest problem is that if you shift now the collection of this freight tax to the payer, to the consignee, the worst case scenario that would happen is that if the tax authority insists that there's 20% withholding tax, then the person who's going to pay is the consignee. And in most cases, the shipping principles, just like any other non-resident, will require their income to be fully paid. So this will be a gross up on the low cost, so potentially increasing the cost of importation. So it will be a curious case there on how KRA is going to interpret that, and then how they're going to implement that. So we wait to see. But from the provisions, the way it's drafted at the moment, that's a risk both for the tax authority and the taxpayers. Then we go to other items. So let's talk about tax losses being restricted to 5 years. Then you're talking about refunds for bad debts being restricted to 2 years as opposed to 3. And then, of course, the refunds period being extended to 90 days. So there, in terms of cash flow, the taxpayers are hit because now the KRA is taking longer to process, while also reducing the timeline for which you can claim for bad debts. On the good part, in terms of exits, they've provided some exemptions. So various ones, we talk about CGT, for any family-owned property or investment. So if we are a family, we have a family company, and we want that those assets to revert to us in our individual names, so long as it's transferred within sorry, this is stamp duty, not CGT. So long as it transferred within the percentages of ownership, then you get a stamp duty exemption. The other big one in terms of inviting capital in or bringing capital in is the NIFC, the Nairobi International Financial Center, the exemptions that they provided and the lower rates. We talk about, again, CGT exemption for family companies, SEZ in terms of transfer of property, basically now defining it that it's applicable to only the SEZ entities. So that's a good one. APAs in terms of transfer pricing, something that I believe Uganda already have. Even Tanzania, I think already they have that in their provisions. So Kenya is doing a bit of catch up there. So very good provision. So overall, very one or two troubling amendments, but many amendments that have come in that are looking at bringing in FDI or attracting FDI into the country. Over to you, Kate.
Thank you, Sam, for that. I think, Enoch, I'd like to throw the same question to you. What are the significant changes that you've seen in terms of both income and indirect taxes that you think will affect us taxpayers both positively and negatively?
Yes, thank you again, Kate. I can see some similarities in effect with the Kenyan bills. For starters, as I said, you will see that there is a lot. There is a drive to encourage small enterprise. And that is largely because of our large youthful population and the attempt to create jobs for them. So one of the things is the income tax is introducing an income tax exemption for small businesses whose investment does not exceed 500 million Uganda shillings. So you can see that the exemption is meant to they are not giving the big boys the advantage, so to speak. This time they are giving the 3-year advantage to the smaller enterprises. Of course, there are some conditions, not exceeding 500,000 shillings, not having previously benefited from an exemption, and to have, of course, filed tax returns, etc. So that one we think will definitely encourage some investment or give some relief to some people, but also it's meant to encourage formalization of these businesses, because we have a lot of the small businesses that operate informally. So part of this exemption is not only to give them the advantage or the ability to be able to unburden their startups, but also to encourage them to formalize in order to take advantage of these exemptions. Then we also have a continued exemption for another 7 years for one of our big hydropower projects, the Bujagali Dam. That exemption has been extended for a further 7 years. Of course, that is intended again to keep our tariffs stable, our power tariffs stable, both for the common consumer and also for industry. So basically to keep our electricity affordable and cheap. We have also seen just like Kenya, there will be maybe let me just finish the Income Tax Act. We now have a 15% withholding tax on digital services provided by a non-resident to an associate in Uganda, as opposed to a 5% digital tax that was there. So now we have a withholding tax of 15%. So there is an increment in that regard. We have had these debates about digital services for a while. Remember, at some point we had an ongoing dispute with Facebook and things like that. So this is I think this is not a problem that is unique to Uganda. It is certainly a problem that the other African countries and the other developing world face, seeing that a lot of work and a lot of enterprises going digital and would not control the platforms on which these digital services are being provided. So then we also have something similar. The context is somewhat different from the Kenyan one on the exemption on stamp duty and the reorganization of business. We now have an exemption. We have expanded that reorganization, because previously it was from company to company, but now the Income Tax Amendment Act has expanded that to allow also an individual to transfer their assets into a company, for example, in which they have shares, and the distribution will be done accordingly. So that I think to encourage people to, again, first of all, formalize business, be able to make use of resources, in order to have assets as part of the capital of business, and so make them more useful. So that is there. It is quite similar to what Samuel just stated regarding family properties and the exemption of stamp duty on the transfer. Then we in the Value Added Tax Act we have a provision that gives now power to the Commissioner General Tax Authority to recharacterize imports. Previously, if you imported goods, if you are not VAT registered and you imported goods that met the VAT threshold, then you would be compelled to register for VAT. So it appears that in some cases, some importers would split consignments in order to remain under the threshold. So what this amendment is saying now is that it gives the Revenue Authority the power to examine the various consignments, and if they are deemed to be the same, to characterize them as one consignment and charge VAT and compare the registration for VAT. So you will notice that the theme again of improving compliance and trying to capture as many businesses onto the tax system as possible in our amendments. We also have exemptions, various exemptions, for example, on VAT on deep cycle batteries, solar lanterns, and materials that are used for that. That again is a drive to promote the use of renewable energy, of course, with the whole environmental concerns and climate change and etc. And also, of course, to give cheaper, because some of these things are cheaper than the hydro energy that we have. In Uganda, we have excess power, but the problem is on the consumption, at least domestically, household consumption, which goes to affordability, the affordability of the power. So we have excess power, but not every house is lit. Not every household is lit. So this also goes to improve that. That also goes with exempting biomass pellet, which again is the same thing from VAT. We also have an exemption of, there was previously an exemption on the supply of billets from outside Uganda. Billets is for steel production of steel products. That exemption has now been taken away in order again to encourage the local value addition, the local production of billets and the value addition to the billets that are locally produced. Again, we can see that we are moving to encourage value addition here, encourage more job creation here. There are also exemptions on textiles produced here and materials used to produce textiles here. And when you go to the Excise Duty Act, at least of the previous years, the excise duty on imported textiles was correspondingly increased. This time it has not been touched because it had already been increased before, and that was again part of the drive to encourage value addition here, to encourage industrialization and so on and so forth. We have also exempted the supply of aircraft. This again is of course we have a fledgling airline. That's number one, but also to try and encourage acquisition of small aircraft, which would help in promoting our tourism around the country. So ideally, that should be able to encourage some people to invest in aircraft for our what they call the domestic flights, and encourage tourism and so on and so forth. The other area has come also to improve compliance in the Tax Procedure Code Act. So that now we have, previously we only had the tax identification number as your identification for tax purposes. So this has now been expanded to include your national identification number and your business registration number. So those are not just included, of course, for purposes of identification, but what that also means is that all these sources of data are now integrated. So if your business registration would be linked to your TIN number, would be linked to your national ID, and so on and so forth. So eventually, the digitization of the whole system, I think that's what we are going for. And corresponding with that, we have introduced now stiffer penalties for non-compliance. We have, I think you have your systems are called teams and something for that. We have the electronic fiscal receipting and invoicing solution, what we call the IFRS, which requires you, of course, to issue these invoices using that system or to issue receipts using that system. Now, previously, the penalty has been that you pay the tax due or 400,000 currency points, whichever is higher, not 400,000. Or it's something along those lines. I think I'm stating the figure in terms of currency points, because that would be. But now it is what the new provision is that you will pay double the tax due. Now, we had some taxpayers had gone to court because in terms of enforcement, the Revenue Authority had raised a penalty on each default. So each default, so each invoice, they had raised a penalty of over 6 million shillings each incident. So I think the court had ruled then that no, you can only that penalty can only be 6 million per day, I think, per day, not per transaction or per failing in the system. What this does, it actually reinstates the other one in a sense, because they are saying when you don't do it now, you pay double the tax. So it's no longer even a fixed amount. It is now double the tax due, and depending on how URA deals with this provision, it can turn out very badly, or it can have the right effect. The right effect is supposed to enforce compliance. Use the system, and so on and so forth. But how can it be used wrongly is if you use it instead, strictly speaking, as a revenue collection tool. That means you're not going to be looking at justifiable mistake, something, and then you clamp down on taxpayers very, very hard. That will likely have the wrong effect on business. So those are those. Then we have also had in the Excise Stamp Duty Act removed stamp duty, which was previously 0.5% on mortgage deed, memorandum of agreement, that has been removed. Additional collateral, auxiliary. So all that documentation, I think, in a bid to collect more revenue, URA was enforcing. So even things as simple as an employment contract, so you'd find a large organization which has been doing these mundane, very mundane things, including simple procurements in your organization. Of course, for some organizations, those procurements can be a bit sizable. You would find that now you are being told to pay 15,000 shillings on each contract. So what this is doing is removing that to keep down, I think most importantly, the cost of borrowing and the cost of accessing capital. So those are some of the positives. Largely, most of them are positives. Again, in the Stamp Excise Duty Act, you will find that the percentage increase. If you are making fruit juice or processing fruit here, you would be exempt from excise due to the extent of about 30%, I think, of the inputs. Now that has gone up to about 50%, and that covers juices and products of juices from Uganda and within the East African partner states. So again, it has taken into account a lot of that. There are other the details are many, but so far those are some of the key highlights. I think maybe the other thing about the other similar thing I see with Kenya is there's going to be an increase in the cost of imports, because the new acts now have imposed a compulsory 1.5% infrastructure levy on all imports originating from outside the East African community. So that will definitely increase the cost, and also a declaration fee on imports for home use of 1%. So that will definitely also increase the cost of imports in Uganda. Thank you, Kate.
Thank you for that, Enoch. I think there's a lot that Kenya could borrow from Uganda in terms of some of the things you've highlighted, like the exemption for startups. I think that's something that small and medium enterprises would really enjoy in Kenya. I think one of the good things with your finance bills and your Finance Act is that it's very brief, it's very succinct. You don't have as many measures as Kenya and Jiduma. I'm sorry to say, also Tanzania, we have around 30 income tax measures every year. I think Uganda has a very brief Finance Act, which is good for taxpayers. I mean, it creates a degree of predictability and certainty. So thank you for that, Enoch. Jiduma, moving on to the changes to the Tanzanian Finance Act 2025. So there's the measure that has been introduced that special economic zones and export processing zones that offload their goods to the local market no longer enjoy the tax holiday. So maybe you could tell us a little bit about that, and also in terms of the tax incentive framework that is there in Tanzania. Are you seeing a shift towards a reduction in tax incentives, which is one of the moves that Kenya is making? So is that similar for Tanzania? Is that the same case?
Okay, thanks, Kat. I think, yes, generally you see a trend towards the reduction of tax incentives and probably strict tax avoidance measures. I can discuss that with highlighting some of the, which I could consider negatives in the bill. I don't know, in the act. For example, just a minute. So the one you have mentioned, companies registered under special economic zones or economic processing zones were enjoying a 10-year tax holiday, but which didn't have a lot of restrictions. But now they introduced a restriction that if the product are not exported, that incentive does not apply specifically to that particular transactions. So it's a restriction on the incentive or exemption that was there. But also, we have historically we had a deduction of tax losses in the income tax computation. If you have tax losses, you can deduct them indefinitely, and had no restriction. We still have the indefinite limit, but a few years ago they introduced the limit that if the current year has a taxable profit before you bring the loss from the prior years. Now we allow you to bring the loss from prior years, but they can only deduct to the extent that we need to remain with at least 30% of the current year profit. Now the excess loss you can carry forward to the subsequent years. Now they've uplifted that to 40%. I can anticipate probably the next year can be 50%. And it's probably a direction towards I heard in Kenya you have a restriction of this time of up to 10 years. You don't have that privilege anymore. I don't know if I got that properly, but I see that trend in our tax regime as well. Most likely the next few years, we might say if you are incurring tax losses, we give you up to maybe 5 years or 6 years, whatever, but you cannot continue having an allowance deduct your tax losses. So that is the trend you see in limiting the tax losses. We have also what is called alternative minimum tax, which my understanding it was tried to be brought in Kenya a few years back, and it wasn't successful in the court. But we have it in Tanzania since 2009, and when it started, it came very, when the politicians are smart. At that time, there was a lot of outcry for the mining sector that they are enjoying a lot of incentives, they're not paying taxes. So when this was introduced in 2009, it was like targeting corporate entities that are making tax losses as a result of the tax incentives. So actually, they're not paying taxes because of the tax incentives. So everyone saw it as positive, and it was like it's not targeting the mining. Now, a few years later, they realized they're not probably collecting a lot by just targeting those. So they removed the aspect of the loss being caused by tax incentives. So it became general if you are in losses and initially it was up to the 5th year. So you have been in tax losses for the past 4 years. Now in the 5th year, if you're still in tax losses, we tax you on your turnover at 0.5% of your turnover. And then subsequently, so 5 years is too long to wait. So they reduced to 3 years. So if you are in losses for tax losses for the past 2 years, in the 3rd year, we apply the alternative minimum tax. Now this year, they increased the rate. It was 0.5%. Now they're moving to 1%. So you see, just generally, I'm trying to show how the trend towards measures to increase revenue collection through limiting incentives and also restrictions on which are more on tax avoidance limitation. So you use which is the same also this taxation of deemed dividends, which was not there in our legislation. So it's a new in our tax regime this year. Although at least in the bill it was very harsh, but somehow it has been softened a bit in the act. But it's a new measure in our legislation, which is it is being defined as because of the reason to curb tax avoidance through refraining from declaring dividends. But it's more of also an avenue for collection. There's been also a number of increases in the withholding tax rate. For example, we are taxing insurance premium paid to non-resident insurance providers 5%. Now it has moved to 10%. Also technical services in the extractive industry, mining, oil and gas, and petroleum. We had a withholding tax at 5%. It has been increased also to 10%. We have introduced a new tax on sale of farm of forest produce, which was not there. Now it has 2%. So to answer your question is there's a general trend towards limiting or decreasing tax incentives, and also increasing strict measures on tax avoidance. Maybe before I forget that in the tax administration, there's also a measure to empower the Commissioner General. One is to digitalize the tax administration system. So, but in addition to that, which is mainly my point here, is that the Commissioner General has been empowered to require any taxpayer who operates an electronic system to interface or connect his electronic system with the TRI system. Basically, to make TRI be able now to be like an actual employee or CEO of the operations of the company. Because if you're operating an accounting system, for example, and they want it linked directly to the TRA, so they can be able to see any posting, any adjustment, everything. It's like now they're becoming part of the workers of the company. But now you don't know how it can be used. You must say why are you afraid of that? Is there anything you're hiding? But the trick with the authorities is that skepticism we call in audit for the taxman is goes to the negative side. They might just be help you when there's a positive aspect of positive the system, but any adjustment is not considered genuine. So you find with a lot of administrative and a lot of meetings or discussion with TRA, try to explain whatever adjustment that you might post in the system, which could be administratively cumbersome to the taxpayers as well. So I think for now I can end there if there's no additional question.
Thank you for that, Jigma. I think we've seen there's a bit of a trend in terms of the finance acts that come out of the three countries, or at least between Tanzania and Kenya, in terms of reducing the tax incentives. For the alternative minimum tax, we could, for Kenyans, I think we make a lot of noise in court, so the minimum tax didn't survive, I think, even a year. So yeah, I think we could help you with that. Sam, maybe you could talk to us about the policies that inform the finance acts that come out of Kenya. Do we have something that creates stability and predictability for the finance acts that come out each year? Is that trend that you've seen in the past couple of years?
Yeah, thanks, Kate. So the National Treasury, together with the policymakers in Kenya, have provided various long-term, medium-term plans, which they state is how tax policy will be governed within the country. But my opinion is that while this beautifully crafted documentation is there, it's not being followed on a year-by-year basis. Because if you look at it, and it's interesting to see what is also happening in Uganda and Tanzania, all governments seems to be faced with a big deficit. So the only way to do that is now come in and see how we're going to raise more capital or more tax revenues. Leave alone for this forum, we're not going to discuss about now how those revenues are utilized. So in terms of revenue mobilization, the perception is one, that there is a lot of taxpayers in the informal sector that are not paying their fair due taxes. And that's why you're seeing a lot of digitization. So whether it's e-Teams, IFRIS, in Uganda, similar policies in Tanzania and also Rwanda, you'd find digitization being a big part of it, and seems to be working, especially from a VAT perspective. The tax authority has reported some increases, but at a certain point it will taper off, but we'll be able to see when that happens. Then the second item is the so-called tax expenditure. So all across Enoch and Jiduma have talked about how in their respective countries incentives are being taken away. I'm surprised by Tanzania stating that if you are in an SEZ zone and you supply locally, then you lose the benefits. Then what is the purpose of having an SEZ zone in the first place? I'm saying it looking outwards. Maybe there's a policy statement that has been provided, because my understanding in terms of an SEZ is to make sure that you bring in more manufacturing locally, the way Enoch was talking about adding value. So with a big market within the EAC, any investor bringing in capital will not part of the attraction is to be close to the EAC market, which is going to continue being big as much as you're doing other exports. So why then would you restrict SEZ benefits for someone who's coming in and putting in a lot of capex to develop the country? So it beats the purpose. And Kenya has put in a restriction for up to 10 years and saying that subsequently you're not going to enjoy the 15% from year 11 all the way to 20th, which to me is again going against what these beautifully crafted medium-term policies have stated, that you're going to have tax certainty. While you have theory where the rubber meets the road, it doesn't really happen. And taxpayers every year have to keep on wondering what will happen. Of course, there's tax lobby and such, but if you give an incentive, at least let it run throughout, or have a grandfather clause that any subsequent amendments that do come in will not affect the investor, so that there can be a bit of certainty. Unfortunately, what I'm seeing across the region is the same. In terms of policy, Kate, I think your question was policy driven mostly. One of the items that I've seen happening, which is a good thing in Kenya, is the explanation of why certain amendments that are being proposed by taxpayers are being rejected. So we should have also a more detailed explanation of why some specific provisions are being brought in, not the general explanation. Going back to shipping, and it's 2.5%, not 3, sorry about that, where they talk about now we're going to make an amendment and we're going to align with international best practice. That's what Kuria, or the chairman for the committee, the finance committee, stated in Parliament. But if you're saying you're aligning with international best practice states, demurrage and detention are part of rate and not taxable in the country. It's taxable where the liner is based. So you can see this contradiction between the theory and actually now the practice. So there will always be a friction there. And while there's improvements and there's a general consensus that we need to have certainty, that is we're not there yet. I'm positive that hopefully in the next 3 to 5 years we'll be able to have a bit more certainty, but I'm not in the short term. It has not been the case.
Thank you for that, Sam. And I think one of the things that Sam mentioned is the trend in digitization, which we've seen across the 3 countries. I think for Kenya, we have the eTIMS electronic tax invoicing. Tanzania has EFDMS, I believe, and Uganda has EFRIS. And Enoch, you had mentioned that the penalty has been increased to 2 times the tax. And I think that's also the same penalty provision in Kenya. So in your experience and from the perspective of your clients and taxpayers in Uganda, what have been the practical challenges with digitization and specifically with EFRIS, with the implementation?
Yes, really the main challenge, Jiduma here has just stated, I think it is pretty much the same. The main challenge has been one of trust, where the taxpayers do not feel very comfortable with trusting the taxing authority with the information. The general feeling always is that the tax authority is less willing to understand the business and how you're operating, and is more concerned with collecting money whichever way, whether it is fair or unfair to you, whether it works or doesn't work for your business. So there has always been that challenge of adopting technology, adopting good reporting standards and good reporting practices. I think it has always been a question of trust. But with time, at least the revenue authority here has been consistent about taxpayer education. It faltered a bit when it was introducing the free system, and there were a bit of strikes among the traders and downtown, but it then went back to explaining how the system works and so on and so forth. So the issue of increasing tax, especially on failing to comply with the free system, still goes back to how will it be used? Will it be used as a tool to encourage taxpayers to get onto the system and do proper reporting and proper bookkeeping? Or is it instead going to be used, strictly speaking, as a mechanism of tax collection, where you're going to be, what do they call it, nitpicking? You're just going to go in to find errors. And I think this is what is the distrust between taxpayers and tax auditors from the revenue side. Is they are always going to want to find a mistake with you, whether or not you are doing the best, making the best efforts with no ill intention. And that has been the main challenge. So earlier, I think the tax was the value of the tax, or 8 million shillings if one did not use the fiscal device, or the value of the tax, or 6 million shillings if one did not use an invoice. Now it is double the tax, so it could be you could end up with a much higher bill for any error. So it still goes back to how we are complying. But yes, there is an increase in the encouragement. It has extended. I didn't mention the gaming sector, gaming and betting, where they now have to all operate through a centralized system, which is hosted with the Bank of Uganda. So that's again to forestall revenue losses through the betting and gaming sector, and try and capture all of them there, try and capture as much of it there. But we also have, you mentioned taxing of losses. That one was done, I think, the other financial year for us. And this financial year, that remains untouched. Everything is the same. And we have a five-year period. Then after that, you get to tax the losses. So that seems common in the 3 countries at least. But they've been, as I have said, attempts to balance on another side. For example, the Excise Duty Act now introduces a remission of excise duty on goods that are either damaged, expired, or obsolete. So that at least, of course, there are parameters to follow, proof of the cause of damage, the right documentation, and the reporting, and so on and so forth. But there seems to be some compensation in other areas to try and make it fair. So yes, the big question is going to be on the books in black and white. We can see that the intention is clear and proper. The intention is to say, no, we understand your business, but we are only enforcing compliance. So do this, and do that, and we'll take care of it. What remains to be seen is whether the practical applicability from the revenue collection side will match the clear and positive intention of the law. Of course, the other challenge that we have had, I don't know the experiences in Kenya and Tanzania, is about exemptions. Sometimes the exemptions are given, but then you are taken through so many loops, so it becomes not so easy to really take advantage of this exemption. Or you get this exemption, then the next day you have a large audit that wipes out some other benefit that you had already got in another under another tax head. So those are the challenges between practical enforcement or practical application vis-a-vis the letter of the law. That is the bigger challenge, I think, that I see, and still goes. The compliance challenge is still one of trust.
Thank you for that, Enoch. I think Jiduma, on a similar point, I believe in the Finance Act in Tanzania, there's this proposal, or rather this measure, that has been introduced for high earners in terms of filing returns, a requirement that I think for individuals with annual turnover of more than 500 million shillings, and for corporate entities above 100 million shillings, there's a requirement to now have certified public accountants to handle their returns, if I'm not wrong. So from your perspective, in terms of tax compliance and tax administration, would you say that there's a move towards simplification of tax compliance for taxpayers, or is it a shift to the negative, to overregulation? Like Enoch has said, there's a public trust issue that the URA, or the TRA in this case, has visibility of all your transactions.
This is a very complicated part. Initially, we had a similar provision, but it was limited to all corporate entities. So if you have a company, your return of income has to be certified by an auditor, as a CPA, certified public accountant, which is technically an auditor in our case. So in practice, the same auditor who audits your financial statements would also do a certification in your return of income for purpose of submission to the tax authority. So initially, where there were manual forms, there would be a part for management to sign and a part for the auditor to sign on that return. So in the same way, when we started the electronic filing some years back, the submission, the electronic filing would not be complete until an auditor is certified. So that was for companies, regardless of the turnover. So if it's a company, it's just like that. Now for individuals, we have a system called the presumptive income tax system, which applies up to 100 million threshold, turnover, 100 million Tanzania shillings turnover. Above that, you have to prepare financial statements to be audited, and then the filing would just be like that of a corporate entity. Now, we don't know if they will change the filing system, because as far as the electronic filing system is at the moment, any company would not be able to file without that certification of the CPA, because the system wouldn't allow. It's the same for individuals with above 100 million, not even 500. So unless they change the programming of the system, if they do, it is a positive change, because now a company below 100 million shillings turnover wouldn't need an auditor to certify the return. Means it can just be done internally. So at least if he or she will save that cost of paying an external auditor for purpose of certifying the return. Although they will still have to prepare audited financial statements, because the requirement of the Companies Act has not been removed from the side. So they still need to retain an auditor for auditing the financial statements, issuing an audit opinion. They will only get a saving from the certification of the return. So yes. So if the filing system will be amended to accommodate these changes, you can see some cost saving for the auditors on that respect. I think I've addressed that. Now,
Yes,
I wanted to comment some.
Sorry.
Yep.
It's okay. It's okay. Go ahead.
Okay. I wanted to comment some few positives on, if I have some time. Initially, I discussed most of the trends which are more of the paying side, deduction of incentives and tax avoidance measures. I wanted to just briefly share also some of the positives in our Finance Act. Like one, we have introduced retained earnings in the definition of equity for the purpose of determining the thin taxation rules. Now, some years back, we had that same provision, which included the retained earnings as part of equity. But now there was a complication when you have accumulated losses rather than positive profits. So the Revenue Authority would use them to deduct against the share, and at some stage you end up with a negative equity. So it was complicated. So in 2022 Finance Act, they removed retained earnings. So it was just equity means share capital. Now this year they've reintroduced retained earnings as part of equity, but they've added also a positive weight, like positive retained earnings. So it's different from where it used to be. So if it's negative, we don't take into account. We just deal with the share capital. But if you have positive retained earnings, you add it to share capital to increase the equity for the purpose of determining the allowable interest deduction, which is a positive change in that respect. There's also for individuals who are engaged in transport, we have a certain bracket that they use to determine the taxable, no, actually the tax payable for the year. Now, before it was for a vehicle with less than 5 passengers capacity, that was at 250,000 Tanzania shillings. Now they reduced to 120,000 shillings. So it's a positive also for those small transporters with vehicles with less than 5 passengers capacity. On the VAT also, our VAT rate is 18%. There's a reduction to 16% for unregistered persons who pay through a bank or an electronic payment system. the economy is more of cash payments. So I think the revenue authority are trying to find a way to encourage or to discourage cash transactions, so that like putting an incentive for those who pay through bank or any other measure of electronic payment system, so they get a reduction in the price of the commodity or the price of the good or service by a reduction of 2%. We don't know how it will work out, but the effective date has been set to effective September this year. There's also we have as the rating of locally manufactured garments made through locally grown cotton, which was expiring this year, but now it has been extended to 2028. We also have under the local governments, there's a levy by the local government authorities, which is charged on turnover as a service levy. It was kept at 0.3%. Now they're reducing to 0.25%. Similar to the local government authorities, they also charge a hotel levy, which was at 10% of turnover, gross turnover. Now it has been reduced significantly to 2%. So yes, I thought I should share those positive also as we go along. Back to you, Kat.
Thank you, Jiduma, for highlighting some of those positives. I think because our time is a bit limited, I would like to throw a question to you, Samuel, with regards to the EAC and in terms of integration. Naturally, we share a similar customs law, or rather we share the same customs law, but we work towards having free trade across the three countries. And as Enoch said, for their country, they have the infrastructure development levy, and I think for them, they don't impose it on goods that originate from the EAC. And for Kenya, we have the Miscellaneous Fees and Levies Act, where we have RDL and IDF, and similarly, we exempt EAC originating goods. On the other hand, we see Tanzania having the Industrial Development Levy that is being imposed on goods that come from partner states. So goods that come from Kenya and Uganda will still be subject to the levy. So in your view, do you think that we are on the right track to integration, where we have different tax treatment? We have these miscellaneous fees and levies having different treatment across the three countries. Do you see us achieving regional integration?
Yeah, fantastic question. So all the member states, the way we are governed under ECMA, the protocols, and the treaty under EAC is to state that we are one custom region. So ideally, there should be free movement of goods, of capital, and of personnel. Typically, that does not happen like you've highlighted, and I'll start going back. I believe it was in 2009 in Uganda, when I believe it's BAT had an issue with excise duty. So the case was taken all the way to the East African court, yeah, and BAT Uganda won in terms of stating that we are one customs territory, and these levies, you should not consider that it's an importation. So the definition of saying that you are importing from Uganda or you're importing from Tanzania or Rwanda or any of the other EAC partners is not there in law, because we are one customs territory. So based on that, all these other levies that are coming up are ideally, legally, an illegality, and then they should be challenged the same way that BAT challenged the excise duty that was being imposed on supposed importation of cigarettes from Kenya to Uganda. So where Tanzania is imposing any levies, and it's not only Tanzania. Remember Kenya last year under the Tax Amendment Act imposed excise duty on various items, ceramics, I believe, and at the moment there's already a contest, or Uganda and Tanzania have already raised it with the EAC, stating Kenya is contravening the protocol and the treaty. So similar item would happen for any person who's being levied on all these levies. You'd even go back and look at it. Can you impose a levy, which is basically a duty of customs because it's relating to imports, independently as a state, as Uganda, as Kenya, as Tanzania, as Rwanda, and any other EAC partner? Can you independently impose, for example, railway development levy? Can you impose infrastructure levy? Because all this is supposed to be under one customs category. So the legal infrastructure of how these levies are being imposed per country, there's a case therefore that it should be challenged and it should be deconstructed and completely be vacated. However, from a practical perspective, yes, we do see states imposing various levies, and it's upon the taxpayers and the advisors to challenge this and make sure that they are removed. So whether it's Kenya excise duty, whether it's Uganda excise duty, whether it's Tanzania levies being imposed on partner states, that should not be there. Okay. Having said that, because there's a mechanism upon which any disputes with states under the EAC is there, the treaty protocol and all the regulations, the integration, we are headed in the right direction, I would state that. So any customs amendments, you have to go through EAC. Any disputes are being handled quite quickly. So integration is there. It's going to take time. I believe we are even behind in terms of the calendar, because at a certain point we're even supposed to have one currency. Whether that is going to happen in our lifetime, we'll wait to see. But hopefully it's grinding. It's not as fast. We are not cruising towards it, but at least there's, on a day by day, on a year by year, you can see there's some level of movements towards integration. That's on the custom levies and indirect taxation. For direct taxation, hopefully the multilateral double taxation agreement will be ratified. There's some states who have not yet done that, and hopefully very soon we're going to have the DTA in force, because it's very discouraging even for investors when you come in and explain you already have a double taxation agreement with South Africa, for example, with Zambia in terms of Kenya, with UAE even. And Kenya, you're trying to be, the financial center, but you don't have a double taxation agreement, whether bilateral or multilateral, with your EAC partners. It doesn't make sense. So going forward, hopefully that will be done. And like I said, it's a slow process, painfully so, but eventually we'll get there.
Thank you for that, Samuel, and for the optimistic view on EAC achieving the regional integration. And if throwing the same question to you, but in terms of what next steps do you think we could take to achieve integration? As Samuel said, we've had the DTA between the EAC countries that remains unsigned and ratified for a number of years now. So what next steps do you think we could take towards integration?
First, I agree with Samuel. This is something that is doable. It is something that is possible. and I think the partner states have taken significant strides in going towards regional integration. But as Samuel has stated quite correctly, it will take a while. And there are very many factors as to why it will take a while and why perhaps we have been fallen behind on time, because we are doing perhaps one, we are not all on the same levels, politically, economically, socially. We are not at the same level. The block has continued to expand exponentially, which is a good thing, but so far that has increased the imbalance in terms of the differences between the partner states. For instance, South Sudan is still in a sort of a different state, a bit of conflict. The economy is not quite certain, as you would say. Of course, in the region, Tanzania and Kenya have an advantage over Uganda. I don't know which of the two have an advantage over the other. And then now you come to the social part of it, where, and this is why I think it must take time, is because the population has to come along. Otherwise, you'll have your business community rioting, you'll have your youth rioting, and so on and so forth. So everybody has to come along in order for this to come together. Perhaps, yes, the eyesore here is something like the unsigned DTAs. I mean, that one I don't think would face any resistance from any of our business communities. It should be a fairly simpler thing to do. So those are some of the worrying spots, you say, but maybe there isn't too much commitment to this, maybe not, but it's something that takes time. And yes, that for example should happen. The DTA should happen to the complete harmonization, at least of our tax, our customs regime, as was intended, because we keep seeing these shifts. But also a complete harmonization of that customs regime requires taking into account certain factors, like local production, what things are being locally produced in each of the partner states, then what things would be onward traded from the other partner states. So it's a whole process, but at least we can start with the customs system. If that can be completely harmonized as was intended by the East African Community Customs Management Act, that will give us a good start in terms of trade, and therefore set us on a more clear path towards economic integration before we even get to the financial integration and then the political integration. So yes, I am positive about this. We have to be patient. It has to take time, and hopefully the people who come after us will have the same patience, because certainly it is not one lifetime, not one generation. It has to be carried forward with a degree of consistency and patience. And I must say, that you will. That I think is the main difference, for example, between our bills, our acts right now, and the Kenyan and Tanzanian, is you can see a more, perhaps because of our leadership, there seems to me just an edge, but a little bit of a stronger belief in the East African community than you see in other words, the economic, the East African community integration is more evident in our bills than you will find in the Tanzanian or the Kenyan bureaus, which are a bit more almost entirely inward facing. Yeah, thank you.
Thank you. Thank you for those insightful comments, Enoch. And I think you're right that one of the practical steps, or the first practical steps, is to align completely on customs, which we're yet to achieve. So thank you for that. I think as we're winding up, I'll throw this question to Jiduma. I think we've discussed a lot of things, and the issues that come out from the taxpayers, and the feeling in the business community is a bit of overtaxation, as well as a little bit of over-regulation in terms of tax administration. So in your view, do you feel that there's an opportunity, or do you think that there are steps that the tax administration could take to mobilize revenue without, taking the drastic measures that we've discussed here, like scrapping off tax incentives, for instance, for the special economic zones? Do you think that there are opportunities to mobilize revenue without introducing such harsh or such punitive tax measures every year?
Yeah, thanks, Kat. Yeah, I think they are. In the one, if I take an example of Tanzania, we have a big untapped informal sector. Now, whenever you try to increase strict measures in the tax regime on the which are in the formal sector, you are still you're kind of pushing away the informal sector to formalize, because they still like unsafe operating outside the formal sector. So as much as the tax measures are meant also to curb any tax avoidance or tax evasion, and probably increase collection, but they also have a disincentive of encouraging the informal sector to formalize their businesses. So they need to play around that balance, that someone doesn't see, if he weighs the benefits of formalizing his business, he sees there's more positive. Probably I've been in the formal tax net, but because there are the benefits of being formal, you can access financing easily rather than playing low in the informal sector. So if the tax regime is not too punitive, it encourages people to join. Like if you take an example of this deemed dividend tax in our case, so someone in the formal sector would think, now I'll be paying almost there's 30% on the profit, and then part of my profit, even if I don't take it home, I want to invest in the business, part of it will be deemed that I have taken dividend and then added another with tax on an income that has not been paid to shareholders. So you see, it creates that incentive. So what I'm saying is the need to balance so that we can be able to tap the informal sector to formalize the businesses, and in that way we collect a little from more taxpayers. I think the other, which is also linked to the measures, the digitization. The digitization is a positive measure towards tax administration, and there's also a lot of positive to the taxpayers. Like, when I started practicing tax, the deadline date, everyone is running away with envelopes to go and submit the physical documents to the tax authority. You're running to the bank to make payment, but all that is now happening with the office. Even so, you can meet the deadline even just before midnight. While if it was physical, to just be probably at 5 in the evening. You're out of time already. So there are those positives. Now it's only that the authority has to invest also in one in the human capacity, and if an audit is done, they have to understand the business. There's sometimes just playing with the numbers in their system, and revenue authority sits in the office, gets data from the filing system, the electronic management system, does an analysis of the numbers without even consulting the taxpayer, and then he comes up with a report, 10 pages, 20 pages, saying you were a liability of 5 billion Tanzanian shillings. We are giving you 7 days to respond before we issue the assessment. Now, if that taxpayer doesn't get a good tax consultant to be able to reconcile those numbers, he might end up paying a tax liability, even a huge one, which isn't legally driven, but just is driven by how someone played or misplayed with the data in the system, and the taxpayer or his tax consultant was unable to uncover the mistakes in the analysis. So the level authority should also invest in ensuring that whatever audits that are based on the data that is in these digital systems have to be done in a way that it takes into account the business, and a proper understanding of the taxpayer's business, and so it's not just the numbers outside the business which come up with the liability. So that would also be an encouragement to the taxpayers, and also creating that good working environment between the taxpayer and the authority, which would still be positive measure in terms of growing business and paying taxes. Yeah, that is. Thank you, Kari.
Thank you, Jiduma, for that. A lot of insightful comments that you shared in terms of the opportunities that the tax authority has to mobilize revenue without, overtaxing the current taxpayers. So, Sam, I think just from, taking a forward-looking approach, we've seen in the Finance Act 2025, there's, I think, one of the most, a sector that came out winning in this Finance Act is the betting sector. And this has probably come from years, the fruit of many years of lobbying. So we can see that there's, output in terms of lobbying for legislative changes. So, and you've mentioned the issues and the disputes that revolve around the shipping sector. So from your perspective and from the Kenyan tax law perspective, which tax proposals or reforms would you propose for the Finance Act 2026?
Thanks for that, Kate. So looking forward, we have the biggest problem is revenue mobilization. So you have, and it's across East Africa, that there's no that huge growth that you're seeing within the economy, and actually in some cases there's a decline. The tax authority or are and still you need to create an environment that you get out of the way, basically, for the private sector to thrive. And what you're seeing is the tax authority being more aggressive, and trying to squeeze as much as possible from the current compliant taxpayers, while struggling very much to widen the taxable base. What now the tax authority in Kenya or even National Treasury says that we have over 8 million taxpayers, registered taxpayers, but you find that it's only 1.52 million that are actually filing, and even less of that of who are paying. It's a reflection of our economy. It's it's not that taxpayers are inherently going to evade taxes. Now, having that in mind, that on one side you have a struggling economy, on the other side you have a tax authority and policy makers who aggressively believe that we should be collecting more. And I do agree we should be collecting more, but we need to encourage enterprise. So what should you do? The first thing that I'm looking at in terms of incentives is to bring back and stop shooting ourselves in the foot. So one of the areas is, for example, special economic zones. Why would you give a 10-year, then you give a 10-year 10%, then subsequently you give another 10 years at 15%, then by a stroke of, I don't know what was the policy there, coming in and restricting only to 10 years. Any investor coming into a market, especially the East African market, the African market in general, where there are items or factors that you have to consider, from political, economical, the education, the infrastructure. Basically, you have most of the time to build it for you to be able to get your end product or your end service. And then you shorten the timeline within which these incentives are being done for the taxpayer. It's not sustainable. So I would want to see now some of these tax incentives brought back. So for special economic zones, it has worked fantastic for Asian brothers and sisters. So why don't we bring it in Kenya? So Asia has worked and has shown us the blueprint. We keep on saying we're going to be the next Singapore and such. So why don't you give us incentives to the taxpayers? Then, of course, collaboration. Both Enoch and Jidum have talked about, even if you're given an exemption, the red tape and also the hoops that you have to go through to get that exemptions is ridiculous. So even sometimes you find that taxpayers are not able to enjoy what is rightfully theirs. So remove some of these conditions of stating that you have to go to the line ministry to get approval. The minute that I've demonstrated from the initial, and you've come and audited and looked at my master file and looked at everything that I'm bringing in, the minute I've proven that, why then should we have this paper pushing, basically, because that's what you're doing to get the exemptions approved. Give a blanket exemption to the investors so that they can be able to bring more capital locally. One of the things that I'm liking, or I would give, I would encourage the government to continue, is what Kenya is doing right now with the Nairobi International Financial Center. So you want all this capital to come in. Why should you have funds that are being invested in Africa sitting in Dubai, for example? Why can this be done here in Nairobi? You already have some of the areas that have been set up, traffic, which being an SEZ, special economic zones, where you can set up and have funds there. The Nairobi International Financial Center, once it's up and running already, we have Lloyd's coming in. So why don't we attract this capital? So all these funds are domiciled within the East African region. So you have to have certainty. You have to make sure that you don't give incentives and then a year later you go. We have to look at our brothers from Mauritius, how they've done it, and made sure not only from a tax policy perspective, but from a legal, political, and finance regulation, they are encouraging all these funds to domicile the capital there. So why then are we not really attracting capital into the country or within the EAC? And it's not just lip service. You have to follow it up with proper provisions. So year on year, I would want to see more provisions relating, for example, NIFC. It's a start. They've just given very basic, in my opinion, very basic exemptions. You should be giving more. You should have the first 10 years, it's zero. If I'm bringing in $30 million, as the threshold for which you're making investments. It's not loose change. And I'm bringing into a somewhat quote-unquote politically charged economy. So can I get these investments? Can I get this protection for the capital that I'm bringing into the market? So we'd want to see investors supported, and then certainty that you don't give today, you take tomorrow. Okay. Then for the tax authority is now how you implement and define those rules. I do sympathize with them that they have very huge tax targets to meet, but you cannot meet tax targets but by misinterpretation of the law. We already have very many disputes, which should not be there. You're talking about investment, contractor who's set up outside and also set up in Kenya. And under transfer pricing rules, you're trying to state all this income should be taxable in Kenya. I believe even Uganda have similar, Tanzania have similar cases. Let's have proper interpretation of the law. CFC rules, Jiduma has talked about it. It's a good thing that already there's that one big case in South Africa where the fund managers were able to win, and that income is not being sourced here. So when we draft all these foreign controlled rules, let's make sure that it's drafted properly and it does not cause litigation, which is an added cost on the investor. So basically, Kate, going forward, what we would want is, let's see, yes, tax expenditure, you're saying you're going to cut it, proceed, but let's see exemptions being provided to capital. That's the only way we're going to compete with the UAE of this world, the Singapore of this world, the BVI of South Africa, Egypt, and such.
Thank you for that, Samuel, and thank you for, highlighting some of the areas that require reform. And I think the need for tax certainty cannot be overstated. So I think we're running out of time. I think I see one comment on the platform from Raymond. I think this is with respect to the issue of taxing shipping income. So he's highlighted that there's a distinction between detention and demurrage. Demurrage is port storage. Detention is accrued on empty and is not returned by the consignee to the shipping line, whereas demurrage is accrued on laden in the port. Okay, thank you for that, Raymond. I think, Enoch, I'll throw this question to you first, though I think everyone will share their closing remarks on this. With regards to the Finance Act 2025 and the changes that have been made to the tax framework, what advice would you give taxpayers and businesses generally to comply with the current amendments? Just very quickly, because of the time.
Well, the advice I would give the clients is to make sure really you catch up with the so-called information age. Get as much information as you can to be able to comply. And unfortunately, traditionally, at least speaking from the Ugandan perspective, consulting has always been seen as perhaps a last expense or even sometimes an unnecessary expense. But with the increased digitization, the increased formalization, the extent that technology can go to gather information, etc., because it is affecting world trade and etc., I think compliance is the way to go. And for you to comply, you have to have the right information. For you to have the right information, you need to normalize and normalize making provision for consulting in your businesses.
Thanks for that, Jiduma. Any closing remarks with regards to the Tanzanian Finance Act 2025?
No, I think I share Enoch's comment. To catch up with all these changes and the complexity of the tax legislation, and still be able to focus on your core business, you just have to retain a good tax consultant to handle most of the tax affairs. So how regular it depends on how your budget and how you agree with your tax consultant, but it's going to be very difficult to handle these tax matters internally without having a support of a tax consultant from time to time. Just that.
Thank you, Jiduma. And lastly, Sam, any opportunities for Kenyan businesses for tax savings, any new tax compliance measures, any remarks?
I would say, like you said, in terms of lobby, it's a painful process, but you have to do it. So the more you lobby, the more the fruits will come in, definitely. And we always say within the firm that we look at businesses in 3 ways. So what is your compliance level? Have you complied with current laws, whether it's transfer pricing documentation, whether it's filings, whether it's being updated and making sure even your refunds are being processed? All that is at stage 1 of compliance. Then stage 2, like Enoch and Jiduma stated, is that now when you're coming in to make investments, you make sure that you look at the project. You don't bring in your consultant after the fact. So there's some things that they can look into and be able to advise, be able to make sure that you structure properly to avoid some of the pitfalls or some of the small mistakes that could affect you negatively and erode your returns or even the capital that you've put in. Then at the third stage is now controversy and lobbying. So you make sure that you lobby the laws so that the rules of the game do meet what you're able to play within those rules, that there's no what do we call it, bad law, basically laws that are impacting your investment negatively. So you lobby against that. And then also you look at the current laws that are there. What laws are there that you can actually take it and run with it to court and be able to get a refund? And there are various ones that from within our tax laws, you look at it and you say, if this matter was litigated properly and taken all the way, and since we're EAC, you can always take it all the way to the East African Court of Justice, you'll get a proper ruling that not only will save you on taxes going forward, but you can also get refunds for various taxes that you've paid, which now will improve your cash flow. And also it will be, to put it in Swahili, onyo, like a safeguard that you should not implement some rules that are against what the tax code is. So going forward, I do expect that there's going to be a lot of tax litigation. There's going to be a lot of tax lobby to make sure now, because cost. So how do I save as much as possible? And ensuring I'm still within the rules. You're not talking about avoiding. It's just a matter of proper tax structuring, proper tax efficiency. And there, I believe there's a huge opportunities.
Thank you, Sam, for that excellent comment. I think there's, like you said, there's a need to balance the compliance with the laws and the lobby for a change in the law. I think now we are about to close the webinar, so I wouldn't want to lock anyone out. So I think we've covered everything. Thank you to the panel, first and foremost, for sharing your insights with us, from highlighting the significant changes across the 3 acts, talking about the progress that we've made in terms of integration and the proposals and the predictions that we have for the tax framework in the next year. We'd also like to thank the audience for listening, and we hope that you've picked one or two insights relevant to your business and relevant to your practice. So thank you for that. Thank you for taking time. I think one last comment. There's a form that has been shared in the chat. It's just to give us feedback on the webinar to help us improve in terms of the content and in terms of our presentation. So we would appreciate any feedback that you share. Yeah, I think that's everything. And anyone has anything to add?
Yeah, just thank you again to you, Kate, and to the other panelists, and thank you to TaxWise for arranging this webinar. Thank you.
So thanks, Kate, and the team for arranging this. Enoch, Jiduma for being excellent panelists, and I'm looking forward to more engagement going forward. Like we say, regional integration, so we have together as well as firms, and also to all the participants and attendees. Thank you so much, and we look forward to more engagement. Asanteni.
Yeah, thank you. I think it's a good start. We're gonna have more probably going forward, and we also thank our participants, and we invite them for any more clarification that they might need. For Tanzania, you are most welcome. If you're investing in Tanzania and you want any guidance on tax matters, accounting, you are warmly welcome.
Thank you. Thank you to everyone. We've reached the end of the webinar, so have a really lovely day. We hope to see you in the next one. Thank you.